So guys, shall we start? Everyone is having the file open?
Yes, sir.
Okay. So the point is, if I just walk you through what we did last time was, we were able to forecast the numbers for income statement. We did not forecasted the number of interest expense, which I told you that I will keep it on hold and we will be doing it later on, right? Then we discussed about uh, we projected certain part of balance sheet which were coming from the schedules. So we did for that DNA schedule. So I hope DNA was clear to everyone and everyone has completed in their Excel sheets. This was an additional forecasting that I provided. Only this red one will only be used when you do not have amortization given in the annual report. Then you can calculate. And acquisition of intangible, I prefer to keep it flat, but if you want to forecast, you can forecast it this way. Correct? That's what we discussed.
Yes, sir.
Right. And then we discuss about working capital. Working capital, where I told you only three things are mostly forecasted in real life, which are your account receivable, inventory, and accounts payable. Rest of the things are flat, means whatever is there was in the past will be forecasting the same in the future also. And same goes for partners payable, record expenses, all that expenses and anything. Only three things are mostly forecasted in most of the model. You can forecast prepaid also in these also, but they are not very important. So let's keep it flat. That's what we discussed. And then we calculated the changes in working capital out of it. And then I linked it in the cash flow from operations, right? That's all we discussed. So if anyone has any question on any part of the thing that we discussed last time, we can take up the doubts first, and then if there is nothing, then I can just resume forward with this. So Mr. Kanak, Nallu, Priyanshu, Rochan, any question, anything you'd like to discuss?
No, sir.
No, sir.
No?
No, sir. No, sir.
Okay, okay, great. So let's move forward. So guys, we need to again, start from the top and go till bottom and see which all things we have projected and which all things we can calculate. So first thing is interest income and expenses still on hold. We will be doing it later on. Then if I come to EBITDA, so yes, we can calculate EBITDA portion. So for that, we need to bring the DNA part. So if you know, we already have the DNA portion. So I can get it from say DNA schedule if required. So DNA is this, right? Which is the history and the future, correct? So I can bring all the DNA portions. So can someone tell me how will I calculate DNA? Sorry, EBITDA.
So EBIT plus DNA.
Very good. So we can take EBIT plus the DNA portion. So that will bring you the EBITDA. So this will be your EBITDA. And EBITDA, I told you that EBITDA is a very important estimate. And most of the investment bankers in private equity firms, in any finance activities, EBITDA calculation has become very, very important over a period of time. This is also called as non-GAAP earnings. So GAAP versus non-GAAP is a situation where when I say GAAP numbers, GAAP means any numbers which are basically are the accounting numbers, right? So suppose if I go to the income statement, for example, you see this income statement, these are all GAAP numbers because they are as per the accounting done in the income statement, balance sheet and cash flow. So this is a GAAP number, this is GAAP number, this is GAAP number, this is GAAP number. Every number that you see in income statement, balance sheet and cash flow, they are GAAP numbers. But you see that EBITDA is never reported in the income statement. You will never see in fact, 99% of time, you will never see EBITDA in this. You generally calculate it from your numbers, so which I calculated, which is different from the income statement. So if something is not as per the accounting standard, and if you're calculating something to understand, that is generally a non-GAAP earning or non-GAAP numbers. Is that correct? Is it clear? Non-GAAP means it is not an accounting number, but we have calculated it for an analytical purpose. Okay, so this is EBITDA,
Okay.
EBITDA and DNA we have done. Now we'll move forward. Cash and cash equivalents, we will forecast. So this is on hold. So we'll be doing that soon. Marketable securities is generally the same. So what we will do is we will keep the previous number flat, which is whatever you had as marketable securities. We will generally not forecast it. So we'll keep it same. So this I will say it as it is flat. Then if you want to do it along with me, you can do that. You can calculate the EBITDA and DNA in the meantime. And then you can bring this, right? Next is non-marketable equity securities. So this will be same. What we will do is basically equity securities is like investment in equity, which is long-term equity investments. So that you can keep it flat. There is no need to forecast it, or there is no way or requirements to forecast it. So we can just keep it same. Goodwill will also be same. There will be no projection of goodwill. Then operating lease will also be same. Other assets will also be same. So everything else is same. Only cash will be forecasted from the asset side, which is left. Is that clear?
Yes, sir.
Now, when it comes to the liability section, short-term debt we will forecast, operating lease we will not, so we will keep it same. So when I say same, it means that there is no change in the operating lease. There is no increment and there is no decrement. It is more or less the same, right? Then deferred revenue deposit is already blank. So if you want, you can just delete it. I would prefer to delete this line item. So I'll just select the whole line and right click and I have a delete option because there is no point keeping it something which is already blank. So I will just delete it. And this is how it will look like. Now, when it comes to non-current liabilities, most of the non-current liabilities will also be flat. This will be forecasted long-term debt. So we will keep it blank. But for the rest, we will keep it flat. So all the three things will be flat, which is operating lease, long-term income taxes, and other liabilities. And then we will drag this also. Correct? This will also forecast it in the equity section. And the total will sum up as and when we have the numbers. So please do this, all these stuff that I have just dragged it. If you have any questions, let me know. Kanak, Mr. Nallu, Priyanshu, Rochan, anyone is doing it?
Oh, yes, sir.
Yes, sir.
Please do it. Yes.
Sir, can you show liabilities? What all should we drag in non-current?
Yes. So accounts payable we projected. So I think today we have just kept these two things as same and these three things as same.
Okay.
We are left with which all things? Just look at it. Cash, debt, correct? And the equity. Only three things are left, then we have done with the balance sheet. Now, when it comes to the cash flow statement, let's quickly do the cash flow also before we move forward. We have the net income already from the income statement. You can bring 25 to 29 net income here. So I'll go at the top. I'll bring a net income of 52,000 here so that my cash flow, whatever I projected, should be in place. So this is this. Then do some. Please bring the net income also and just sum it up so that you also have the operations part is ready. Correct? Then investing activity will be only the summation. So what I've done is the sum of both. So this is how it will look like. So please quickly, I'm giving you just 1 minute. The net income, calculate the CFO by summing it up, and then sum the cash flow from investing also.